Hi, good afternoon and welcome to MF Corner. I am Sumaira Abdi. Today on the show, we're going to discuss a topic which is probably a little unusual for retail investors, but it is very important nonetheless, which is why retail investors, mutual fund investors, need to know about the earnings growth and the potential for Nifty and Sensex companies and how it impacts their investments as well as their asset allocation. So what will be the drivers of the future? Perhaps a lot of those answers may lie in studying the earnings of the companies, the underlying, right, of your mutual fund units. Feroze Azeez, Deputy CEO of Anand Rathi Wealth, joins me in this endeavor. And Feroze, good afternoon. Thanks very much for joining it. And, at the outset, I want to tell retail investors that, it may sound a little bit technical, but do stay with us. The idea is not for retail investors to themselves track Nifty earnings, but to know enough to be able to ask the right and tough questions to their advisors so that they know that their investments are on the right track. Having said that, two more things that I want to add before I hand it over to Feroze. There will be two important concepts that Feroze will be talking about today. One, of course, is earnings. What do you mean by earnings? Every company that is listed reports its earnings, right? Which is how well it has done, its balance sheet, P&L statement, etc. And what is then Nifty earnings? Well, Nifty earnings is nothing but the aggregated earnings of those companies. The other concept we're going to touch upon is PE, or price to earnings ratio. Now, what is this? This is a ratio basically which measures the current share price of a stock in relation to its earnings per share, so that you have a unit of measurement by which you can compare companies. So now that we have the basics on board with us, Feroze, welcome. And the first question I want to ask you is, why exactly do you think that investors should be tracking, Nifty or Sensex earnings, and how does it help in asset allocation?
Hello, Sumaira. I think, like you rightly pointed out, that retail investors might find it a little more technical and also unnecessary at times. But to my mind, I think it's very important for any investor, for that matter, retail, HNI, mass affluent, all of them need to at least have a basic sense of the earnings. Because most of the questions they end up asking you, how will my SIPs do? This is one of the most scientific answers you will be able to give so that they can formulate their asset allocation strategy. Earnings, which is nothing but the earning the company reports on a yearly basis, of course, quarter on quarter, has a very strong relation to where Nifty ends up going over long periods of time. In a 4-year cycle, you see a very strong relation to what will happen to the market and the earnings of the underlying companies, which nothing but come together to form Nifty. So it's very important. Second is that unlike in debt, where you can lock in your return for 3 years by getting into a debt fund almost, or an FD, and lock in the return, equities, you don't lock in the return. So you have to have a certain estimate of what kind of earnings which these companies will throw up over the next year or two. Second. Third, very importantly, asset allocation is still a responsibility of the investor. The fund manager will actually choose the stocks for you or will choose bonds for you if you gave the money in a bond fund. But the decision of how much to invest in the equity fund or the bond fund or in a hybrid fund is going to be the investor's baby in terms of a decision making. So having an estimate really, really helps on what direction long-term equities could take.
Okay. Feroze, I noticed you referred to Nifty earnings. So is it only Nifty that investors need to track or other indices too?
I think if it comes to mutual fund investors, Nifty is sufficient. If you go down to the actual lakhs of crores in equity mutual funds, 60 to 65% of that or even more is invested in Nifty companies. So if I'm able to get a sense of Nifty earnings, point one, I'm covering a large portion of the assets invested by the mutual fund companies. Second, generally, Nifty mid-cap would also have a similar directional sense. So you don't have to go down to other indices at all from a retail and a mass affluent investor perspective.
Okay. I was looking at this chart which measures the earnings growth and compares it with the growth in the value of the Nifty, right? earnings have not grown as much as how the Nifty has rallied, right, as an index. What is the reason, and any reason why this correlation is not so strong?
See, actually, there is a correlation. Of course, Nifty earnings, which is the entire 50 companies which were a part of the constituents of Nifty in FY11 or FY10-11, earned 319 rupees cumulative, right? Then when you see the latest number of the pandemic year, the earning is 524, which means all the 50 companies which form a part of Nifty have earned 524. So the growth is 64% in earnings, but the index has moved up by 150%. So earnings has grown by 5%, and price or Nifty movement has been close to 9%. In the previous decade, earnings went up from 126 rupees to 319, which is what we saw on the top of this chart. There, Nifty more than tripled and earnings also tripled. So point one, there is a correlation. 64% is the growth in earnings. 130, 140% is the growth in the Nifty price. The reason of this extra return which the Nifty has given more than the earnings is because of the lower interest rates. So it's very clear mathematically, if you did a correlation, 4-year cycle, there's a strong correlation between earnings and the price movements.
Okay, understood. There seem to have been a lot of changes in the Nifty. I mean, just out of curiosity, right? I mean, like you said, that plays a big part in where the index is today. If nothing would have changed, where would Nifty have been?
See, I think this is a very, very important point for passive fund investors. Quite a few people love investing in index funds. But it's very important to note that the index itself corrects itself over long periods of time. So this is a great news for the passive fund investors. When you invest in an index fund, doesn't mean that the companies in the index remain static. So 14 companies over the last 10 years have been excluded from Nifty in the last 10 years. So that's a lot of companies, actually 17 companies, if I'm right, if I guess right. So 17 companies and 15% of Nifty has changed. So if you invest in an index fund, be sure that the underlying index itself is changing, so giving you a large fillip on the portfolio. And second, coming to your pointed question, Sumera, I think there has been a change. So that change results in almost about 1,800 points in Nifty. Better. If these changes were not done, Nifty would not be where it is. It would be about 1,700 to 1,800 points lower than where it is.
Okay. What has been the average price to earnings multiple of the last 10 years? And, do investors need to keep track of that?
Yes. So price to earning is nothing but the price of the Nifty divided by the earnings of Nifty. So the price on 31st March for Nifty was 14,690 rupees divided by the earning, which is 524. If you did a simple calculation, it will come to 32 PE. How much do you pay, which is the price, and how much do you get, which is nothing but the earnings. So that was 32.5 for last year. But if you look at the forward PE, which is the expectation is 692 rupees is going to be the earning this year, then the PE will come to almost about 22 to 23.
Okay. This 32 PE that you mentioned, would that be a fair valuation? And also, I noticed that you mentioned that lower interest rates have helped. How exactly?
Yes, I think very, very important is to see this 32 in a context. Most people who have been predicting a correction over the last 6-8 months have been highlighting that the markets are not fairly valued. Of course, if you look at the last 10 years PE, which was your previous question, the average has been close to 21. But now we are at 32 PE. So if you look at this standalone, it will be very evident that the market is 50% more value. That means as per the historical valuation, Nifty should be at 11 or 12,000. not at 15,800. But if you look at this year's earnings, which is why it is very important, the Nifty companies are expected to earn, as per all the analysts' estimates, which are reported by the source of Bloomberg, is 692, growing from 524 to 692, which is a 35% growth. The reason why the market is where it is because all the analysts, all the FIIs strongly believe that the earnings are going to have a steep jump, which is unprecedented for this decade. That's why the markets have discounted it and come to a level of 15,800. And I personally believe this earnings, which you're speaking of, 692 as an industry, are very much achievable. And that's why I would say market is marginally overvalued, not substantially overvalued. Even if it is overvalued, it is 5-10% overvalued, not 30-40%.
Okay, fair enough. All right, we need to head into a very quick break at this point, but there's lots more to quiz Feroze on, and especially what all of this means for you as an investor in terms of your asset allocation. All of that is lined up next. To stay tuned in. Hi, welcome back. You're watching MF Corner, and today we're discussing the earnings growth, and in particular the earnings growth of Nifty companies and why it matters to mutual fund investors and how it can help in your asset allocation, how you can expect what will be the trends of the future and decide your allocation accordingly. So Feroze Azeez, Deputy CEO of Anand Rathi Wealth, is with us in this investing masterclass. Feroze, the market is forward looking, right? Now whatever has been the earnings growth of the past is over and done with. Everybody wants to know what are the future expectations, right? So now I've noticed that you're showing a 35% earnings growth. Is that a little aggressive, perhaps?
Sumira, I don't think it is very aggressive. It is realistic, especially on the back of the pandemic year, for several reasons. One is, of course, there is cost rationalization. All companies have rationalized their cost, looking at the uncertainty of the pandemic. That will have a fillip. Lower interest rates and in turn lower interest costs on the balance sheets will create more profitability. On the P&Ls will create a lot of profitability. Third is market shares have consolidated. The smaller players have found it difficult to run a business during these tough times. So all the business and its revenues are moving to larger players, which is what Nifty company is all about. Fourth, the corporate tax cut, which was done by the finance ministry during one of the budgets a couple of years back, is now playing out very well, because if there is more revenue, the corporate tax impact reduction will have a larger impact. So giving all this as keeping all these in mind for 5 points, it's very likely that Nifty earnings will grow from 30 to 35. So 35 is projected. There could be a tolerance of 5% plus or minus on this projection. As the year progresses, it will solidify itself. And if you look at the minutest details of the Nifty companies, I think all the companies are expected to do well in the top 10, except probably HDFC could have a minus 9% earning growth for this financial year. The rest of the 9 companies in the top 10 weights of Nifty are growing at very healthy rates.
Okay. 5% is a deviation, you said, from this estimate. And also, you mentioned HDFC. But on the other side, what would be the companies which would drive this growth? And consequently, would thematic funds of those sectors work?
See, I think if you go top down, of course, banking as a sector has not done too well over the last one year, owing to the overhang of all the NPAs and how there could be a collateral damage of the second wave to the banking and the NBFC sector. So I think that's one sector which in the future can drive growth. But when it comes to Nifty earnings, it's largely very diversified. So if you look at HDFC Bank, which is the largest weight, the earnings growth estimates of all the analysts on the street is about 16% growth. Reliance has about a 15% growth. So to answer your pointed question, can you derive a sectorial fund strategy from this data? I think unlikely. But does it inspire confidence in being in equity and sailing through the volatility, even if there is any? Definitely this data provides, but does not throw up a sector strategy to my mind.
Okay, if these earnings estimates were to translate into reality, would you say that the Nifty could come back to its 10-year average?
Yes, I think the median return of Nifty on a 3-year basis is 11%. I personally think since the last 10 years, CAGR or the growth in Nifty prices has been close to 9%. I think the next 10 years will be greater than the median return, which is 11%. So expecting over the next decade, firstly, 11, 12, 13% return from the top companies of the country is very likely. Second is over the next 3 years, the probability that Nifty delivers you more than the debt return is upwards of 90%. And delivers you double-digit returns is at least 75 to 80%. So those are probability numbers which we estimate using a model.
Okay. So therefore, now let's, to conclude this entire session, what is the asset allocation then for long-term investors? I mean, what should they make of this data? What should be the conclusion? And is there a probability of a market correction this year? Or rather, I should ask, what is the probability?
So, Sumira, if I look at this data very scientifically without a bias, and if I personally believe that 660 to 690 earnings is possible, I would have a 65-35 asset allocation towards equity and debt respectively over the next 5-year investment period. If I have just a 3-year investment period, I would 3 to 5 years, I would have 55% to equity and 45% to debt. Even for a 2 to 3 year period, I would have 1/3 of my money in equity and 65% in debt. And less than 2 years, of course, zero equity and 100% debt allocation would be advisable.
Okay. So Feroze, in terms of the equity allocation, where should investors look at putting their money? I mean, should it be large caps, mid caps, small caps? Which segment will do well?
See, Sumira, to my mind, when you look at this answer, we have to look at what is the relative PE valuation between mid cap and large cap. Nifty, if it's a rare representation, which it is, for the large cap, is quoting at a PE multiple of close to about 30 odd as we speak year on year for the last 4 quarters. Nifty mid cap is at about 38 PE, which means that mid caps are expensive than large caps. So in turn, we allocate 60% currently in mid caps. 60% in large caps and 40% in mid caps, because it is in the range of 8p extra for the mid cap, which is a normal kind of a range. So 40 and 60, 40 favoring mid cap and 60 favoring large cap is the desired capitalization allocation.
Okay. Now, Feroze, at the outset, I stated that, some investors may get overwhelmed by this data, and therefore the endeavor was that, they should have a fair understanding, right? Based on whatever we have discussed, what would be the few 2 or 3 questions that investors can look at asking their advisors about earnings growth and how it matters to their investments?
So the first is, what is your advisor's estimate of the earnings growth? Like you have Anand Rathi's opinion of 34% earnings growth for this calendar year, this financial year. It's very important to understand your advisor's earnings growth estimate and the rationale. Why is it important? Because you will be able to derive an asset allocation from it. So from Anand Rathi's research, you've got a specific asset allocation, 65-35 for 5-year plus investors. But your advisor might have a different opinion and might have a lot of data researched. And the allocation could be 20 to equity or 80 to debt. So that's the first question. What's your opinion on earnings? And in turn, what's your opinion on Nifty? Second, if the earnings are happening as you go along or not. So basically, a retail investor needs to ask this question every quarter to the advisor. Why is it important? Because if you love cricket, for example, would you not be interested in the score? I would be interested in the score if I love cricket. So the earnings is nothing but the scorecard of all the companies on Nifty. So look at the aggregated number and you just have to keep a tab on one number. And I don't think that's too much to ask for from a person who's putting his hard-earned money. So one number, 690 is the earnings number for this year. On a quarterly basis, you should try and ask this to your advisor and get your asset allocation correct so that you don't panic during the period of volatility. Second, when the market falls, if you see if the market has fallen, but the earnings are good, you don't need to panic and exit, like quite a few investors exited from the market last year.
Understood. Feroze, thank you very, very much for joining in and for explaining this whole new concept to mutual fund investors. And perhaps in a few weeks or months, we can look at doing this again for everybody who might have further questions about this. Thanks very much indeed for your time. So with that, we have come to the end of MF Corner for today. I hope you enjoyed this session and I hope it was beneficial for you. If you have questions or comments, do write in. Our contact information has been flashing for you. We look forward to helping you solve your queries. Thanks very much for watching. Closing bell is up next.